My name is Marin Katusa, and I'm the Chief Investment Strategist at my own firm, Katusa Research, and we run one of the largest funds in the resource sector.
What macroeconomic policy will have the greatest impact on the global economy?
Well, I think without a doubt it's NIRP, negative interest rate policy, that the bankers are using as the new stimulus. I call it an FTD, a financially transmitted disease, and I don't think investors or the media or even the central bankers truly understand the implications that this FTD will have for portfolios stemming from pension funds to retirees to even sovereign wealth funds to down to regular portfolio managers. So we're in like I call it the Keynes's quantum economics, where when they originally modeled this, there were no negative interest rates. So everything's kind of in this new uncharted territory. And I think it's going to have drastic effects across the board. And, there's this misconception that your mortgage is going to be cheaper or people will be able to get access to cheaper money. That's not how it's going to work. The velocity of capital is going to really, really slow down. And it's going to be a select few that get access to this cheap or negative interest rate policy money. So it's going to have drastic negative effects such that, almost like in China where you have the government rate and then the shadow market rate. I see that kind of happening in the rest of the world now, and it's going to have serious implications.
What impact will negative interest rates have on inflation or deflation?
Without a doubt, my opinion is it's deflationary. If you look at what the impacts are, and I wrote 40 pages on this in my publication, the amount of capital chasing the fixed number of goods is going to be less, hence that's deflationary. And you look at the velocity of the capital is also going to slow down. So it's going to have this double impact. And again, a lot of people think this is a short-term, fix, kind of like what QE was. I'm taking the other side of that bet. I think it's going to last a lot longer, and negative interest rates are going to go a lot lower. For example, if you look at how these bonds are trading, so you got the negative interest rate. So first thing you ask yourself is, who the hell wants to take a negative interest rate bond? But that's not. These bond managers are looking and going, holy crap, it's trading at like a 30, 40, 50% premium, and that's what they're looking at. So they're willing to cut that in so they get their bonuses and they get all the numbers that work for them. So it's this self-fulfilling prophecy. And rather than returning 35%, maybe they'll return 20, and they'll go a little bit deeper on the negative interest rate. So this is kind of the spread's going to keep getting bigger and bigger. That's what I see happening here.
How much further negative can interest rates go?
10 years ago, no one would have ever thought that this would even be where we are. So it could go a hell of a lot lower. Could it go negative 2.5? Sure, why not? It all comes down, it's all relative basis. And, it goes back to my days, I used to teach calculus. Quantum mechanics essentially was, you can't take the square root of a negative number. Then they said, well, introduce an imaginary variable, and voila, long story short, you get quantum mechanics. That's essentially what we're doing in, this new quantum economics with negative interest rates. So if we're at, negative 3/4, why can't we get to negative 1.25, negative 1.5? That's what happens in an FTD. This is going to spread virally.
What impact will negative interest rates have on real people?
It's going to be awful, and yet they think it's a good thing. Really, they're injecting themselves with this FTD, thinking that it's going to help them. They think it's a steroid for themselves, when the opposite, it's a virus for their portfolio. So, for example, say you're a 55-year-old guy, you're going, wow, I got this mortgage, I can refinance it. My kid's a useless millennial. He's probably going to move in the basement with his girlfriend, and they're not really doing anything. They're trying to find themselves in their art career or whatever the situation may be, and they're going, well, I'll refinance my house. I'm all for negative interest rates, but what they realize is you're not going to get a negative interest rate mortgage, okay? So that stops there. Secondly, their portfolio, their pension funds are going to be significantly impacted because these pension fund managers, when they started this 30, 40 years ago, when they started in their careers, they expected it, between 5 and 7% earnings year over year on the thing, but you're not getting that in the bond market. So it's turning everything upside down. So their investment returns are going to shrink significantly, but pro rata, their cost of living and access to capital for the average working person, the average person who needs that capital to sustain their mortgage or car, they're not going to get negative interest rate. They're not going to get any of the relief. But no one truly understands what's going on here, and hence why the central bankers are kicking the can down the road, and the politicians are totally okay with it because everyone lives on this 4-year cycle, and they're not understanding the long-term implications. And this is why I said, in this case, believe it or not, the US dollar actually wins and gold wins. Those are the two places that I think people should have some exposure. And a lot of people go, well, what about Bitcoin? I go, sure, why not? have a little bit in it. I'm no Bitcoin expert. What I did was I put a significant amount of money on one of the larger shareholders, and who I think is a super smart guy who's really focusing on Bitcoin and industries that I'm not paying attention to. So yeah, have yourself exposed to areas that should benefit from this FTD that is happening virally.
How widespread could negative rate mortgages become?
So you got to look at who's getting it, how they qualified, and you can argue that here in Vancouver there's so much subsidized housing that in downtown some poor bastard spending $3.5 million on a 2-bedroom apartment, and then next door to him is a subsidized housing at 80% subsidized. So technically that person has a negative cost of living versus his peers. So you first have to ask yourself who got that, but more importantly, what the size of that mortgage is. And I just don't see the banks getting to that point because, then we're in a basically socialist state, right? And then at that point, you're going to get taxed on your cash and your portfolio and all sorts of things. And interestingly enough, a lot of people don't know that in Canada, pre-World War II, you used to get dinged taxed 3% on your assets that were deemed in your portfolio. So back then, they take your cash and your assets, whether you own stock in a railway or whatever in the bank, and they charge you 3%. So that you would have to pay that in hard cold cash. Now they changed things with property taxes and they took that tax away. But eventually I do see that also coming back because, the pendulum sure is swinging to, I don't see people getting negative interest rates for houses, because then it's just, how do you control things? Then we truly are in a quantum realm of economics, which doesn't make sense at all.
What happens to savings rates with negative interest rate policy?
In a negative interest rate policy world, people are recognizing, they'll eventually realize that, oh crap, I'm going to retire and I'm not getting the returns I expected to have, and I'm, somewhat fiscally normal, maybe not conservative, but fiscally I got to figure out how to pay ends meet. And it's going to affect the economy because you're not going to do those spontaneous purchases that you regularly did. You're not going to do the vacations or the big dinners. Instead of buying a $200 bottle of wine on your anniversary, you might buy a $50 bottle of wine or a $40 bottle of wine. And that's just a natural evolution of these things. As people start to retire, they start planning and becoming more conservative, and that's going to have its ripple effects across the board. So it's going to force people to save. Then the irony will be, then the government will probably bring in some tax on the savers. So, the government's going to screw you whichever way you think, and that's just how it is.
What about bonds?
I actually see that the trend will continue. So as negative interest rates decrease, and they'll continue, there's going to be kind of a new junk bond era where it's not based off of the old valuations we've seen. For example, the Austrian bond was up over 55% at a negative 0.6, and the bond managers were all over it. So maybe the next savvy banker will say, hey, we'll do -7, and we're happy with yielding 35 or 40% on the trading of the bond. So that's kind of the realm I was talking about earlier. I see that continuing longer than people expect, because people are going to have to put their money somewhere. So they're not actually, now the bond market, a way to think of it is, it's no longer playing the bond for the yield, it's actually playing the bonds for the return on the bond, if that makes sense.
What is your outlook on the US dollar and gold?
Let's talk about how the US dollar plays its role in the resource sector. So over 90% of all capital infrastructure and debt globally is financed in the US dollar. So pick any commodity you want. Let's take uranium, for example. The world's largest producer of uranium is called Kazatomprom. The Soviets drilled out this stuff back, and between World War II all the way to the fall of the Soviet Union. So Kazakhstan has these incredible uranium fields that produce what's called unconventional, but really the majority of the world's uranium is produced via ISR, or used to be called ISL, but now it's called ISR. So I call it the conventional way of doing it now because it's the majority. And how they funded this was really clever by the Kazakhs and the Russians. And if you ever go to Kazakhstan, the language is Russian Cyrillic. The Russians are still there. For people to think that the Russians aren't involved is a fool. Half of the production goes to Russia. So the Russians and Kazakhs are completely aligned. But what they did brilliantly here was they brought the foreigners. So like the company Orano used to be called Areva, that's the French national company. They brought their money to fund the development of these fields. Cameco, Canada's largest producer of uranium, they brought their funds, and I'll use them specifically as an example. So they used to be the world's largest producer of uranium. They're the third now. So back about 12 years ago, when Cameco struck a deal with Kazatomprom, on the Inkai project, it was 60% Cameco, 40% Kazatomprom. It's a world-class deposit. Nothing against it. Makes money at $12, $13 uranium. But Cameco put up 100% of the money for it. Then as time happened, Cameco started getting their returns, their debt back. The Kazakhs, or let's call them the Soviets, the former Soviets, said, hey, Cameco, we're doing all the work. This is our land. Our costs are going up a little bit. So let's renegotiate. So today, it's 40% Cameco, 60% Kazatomprom. So I say that this trend is in motion, right? That's part one of this. Part two, the CapEx is built. You have sustaining CapEx, or OpEx, we call it in mining. But generally, the big costs are the front-end upfront costs. Now, yes, you got production zones and there's costs going on, but you're producing in a devaluing currency, the tenge, which is the Kazakh currency, and you're bringing in US dollars. So today, the spot price of uranium is about $25 a pound. The Kazakhs are doing better today at $25 uranium than they were at 40 because their tenge is devalued at that ratio. So we're there. That's what's happening across the board. So the Kazakhs, in the last 2 decades, went from 1 million pounds of domestic production when I first went there in like 03 to about 40% and change of the global primary production without really using much of their own money. It was using foreigners. So they're kind of fixed. And they're going to take, they're going to be horse trading to get more of that asset. And what is a foreigner going to do? You're in the former FSU at the Kazakhs. You're not going to screw around there. You're going to pretty much, I see Cameco ending up with maybe 25 or 30% of the asset. And the Kazakhs are so smart at this. Don't ever underestimate them. And that's just uranium, right? So that's my whole thesis of the cut-to-kill strategy. Take copper, for example. If you just add Chile and Peru, that's about half of the world's copper right there. Well, what's going on with their currencies? The big mines, the CapExes are in place. Now they're getting in. Yes, you still have OpEx, but they're still making great money at $2.50 copper because their currency is devaluing. So is there a reason why the price of copper has to go ballistic? No. So that's a deflationary effect on these commodities that I've been kind of talking about here. And then all these guys go, hey, well, Marin, come on, we're running out of copper. The problem with most of the people in the resource sector, they use linear mathematics. They think, okay, 3% year over year. That's not how the world works. Fortunately, my skill set is in math, and I say, well, here's my model, here's where I think, and I think this whole shortage of copper by the end of 2021, I don't really buy it. I've been involved in building and actually on the director of one of Canada's largest copper mines. When the tough gets going, the one thing you can say about miners, they're kind of like, they know how to survive. They're very resourceful, and they'll start figuring these things out. And you see so many examples that guys are reducing costs, producing more with less, okay? So that's a trend that we see going on. Now, if you look at, for example, gold, if you take, we're over $2,000 Canadian ounce of gold, and I wrote about this a year and a half ago saying, hey, we're going to have $2,000 gold in Australia and Canada, and your costs are in a devalued currency. Look what's happened to the Australian currency and the Canadian currency. So yet that's a great place to be fundamentally where, and another thing I say, if you're a non-US citizen who doesn't have US dollars, gold is a must. But for the American citizen, you're not going to have that big bang on the gold compared to a Canadian or a Russian or a Turk or a Argentinian because of the devaluation factor. The best way to play that would be through the equities, which will get that big, when I remember when Grant videoed me a few years ago, look what we experienced with Newmarket that became Kirkland Lake. These things went up 60 times, and we're not even really in a big gold market yet. We'll be there. But for the Americans, the best way to play it, and the gold guys who buy and sell gold, they hate when I say this. For an American, the best way to play it is through the equities.
What about natural gas?
So natural gas, we don't really need to talk about it. There's so much of it. And you look what's going on in Europe, it's kind of a byproduct with the shale. You can't give this stuff away, okay? So like natural gas, be very careful where you invest in natural gas.
Do you see natural resources equities as better investments?
First of all, that would be the only reason to invest in the equities is because you're taking way more risk, so you want much bigger return. The easiest way to play it is just buy gold and sit on it, take no risk. The only risk is somebody steals it from you. So if you're going to play the equity, you got to ask yourself, what's your time frame and what's your risk tolerance? I think it's going to be very different than what Rick's experienced through his generation. And Rick's a really good friend of mine. We're partners. We've worked together for years. In the old days, it used to be today the boomers they would speculate, and you get these newsletter writers, and the market was a lot smaller back then, and these juniors would fly, and everyone, the rising tide raised all boats. The big difference now is never compared to today in the past has so much money been managed passively. And what I see happening here as part of my article that I wrote was this passive management. They don't have guys like me and Rick sitting around going, well, here's our inflows, what should we buy? These are algos, and they're charging things. They're looking at, minimum market caps, minimum volumes, they have this very complicated thing, and they're throwing money in the market. They're not going to go downstream into the juniors, so they're going to play in these bigger caps. And we're seeing that today, where historically it used to be that the juniors used to be so overvalued relative to the majors and mid-tiers. Now we're seeing that the majors are trading much closer and even above NAV. So some of these streamers like Franco, they're trading above NAV, which is you're basing future value into it today. That's because of this passive management just coming in. So in a way, you can argue that that money's the dumb money. Like in the past, retail money was seen that way, but yet there's very little retail money today. So you get these juniors that are trading at a huge discount to NAV. And what's going to happen, I think, differently, where the big gains aren't going to be made from, necessarily discoveries, which they happen, but they're so rare. 1 in 3,000 ever work and become a mine, where I think it's going to be about buyouts. So that's where I've been focusing out on. And you've seen so many happen where these larger companies who are trading at a much higher valuation or a premium to NAV buy out something that's trading at 0.7 NAV or 0.8. And that's where you want to look at. You want to be able to find quality that's low risk, that's developed, trading at low NAV that someone else is going to buy out. And that's how you get your, what I call the easy doubles and triples. And we've seen them happen like time and again, and we've been writing about it. That's where I think this first phase of money's coming in. Then when the market starts seeing many of these happen in another year or so, as gold gets going, then you're going to see people go downstream, and then all will go up with the rising tide. So I don't think we're there yet, but I think step one is playing that NAV ARB is where we are right now in the market. So the time frame of this NAV ARB, we're seeing it right now. When you look at when I bought just under 10% of Newmarket, which Kirkland Lake merged, that was just an ARB play, and then you've seen it have a 50 bagger return. Same thing happened. You look at what's going on. Atlantic Gold, my friend Stephen Dean, just got bought out by St. Barbara, an Australian company that traded at a much higher NAV, came and gobbled them up from cash because it was cheaper for them to raise cash because they're trading at a premium to NAV and buy out a junior. Well, I call it a junior because they're producing less than 200,000 ounces a year. Bought out Stephen Dean's Atlantic. And it's because he was trading at a discount to NAV, so it's cheaper for the bigger company to issue cash and play that. We're seeing that happen in real time, and you're going to continue to see it happening.
Is there a big difference between precious metals markets and others?
Historically, gold is always traded at a higher premium on both cash flow and NAV. For example, 10 years ago, I wrote about how stupid it is that these analysts and fund managers use 5% NAV when the mine's not even built because the cost of capital is higher than 5. But the gold guys get away with that. The copper guys would never get away with that. The base metal guys never get away with it. But for some reason, the gold guys get away with little differences like that. So they get away with 5% discount. Well, good luck trying to find 5. The only guy who can find 5% money was Ross Beatty on Equinox. He got it from Mubadala. He got it at 5.5, and that's because it's Ross Beatty, and he's put almost $200 million himself into the deal. Other than that, there's no other gold guy that can get 5% money. So using a 5% discount to your MPV is ludicrous, except in gold, which they get away with it. The base metals, uranium, you're looking at 12% discounts, 15% because there's so much risk priced in. So that's the biggest difference.
What is the most interesting investment in the natural resources market space?
I think you got to be in gold and just know where you are, know your political risk. And the other one that I love is, I'm probably the most hated guy in uranium because I've been saying, hey, you got to understand what the Kazakhs are doing. There's a cut to kill strategy here that I've been talking about for a couple of years. The world's largest producer of it has used my data in their PowerPoint. I don't work for them. I got no fees from it, but it's saying that, okay, I've been kind of right on this. I was the keynote at the World Nuclear Fuels Market. I'm one of the largest financiers in the uranium market saying, guys, the spot price is going nowhere for a while. And the best way to play that is through royalties. You want to pick up streams and royalties when nobody wants it. The game for uranium is not over, but you got to be realistic. And people are using $50 uranium in their evaluations. Well, that's just not realistic. So your cost of capital, the best way to play that, in my opinion, and the way I'm playing it, is through a royalty and streaming company in that sector. I take no production risk, I know no permitting risk. You're just playing the strict ARB, and some of the best returns, Franco-Nevada, Silver Wheaton, Royal Gold. You look at these guys who've done these great deals, and that's how you play it.
What are the most promising names in the natural resources industry?
So the last time RealVision asked me that, I picked Altera, which I was the second largest shareholder. That was with Ross Beatty. That got bought out at a big premium for my cost base and my subscribers' cost base because of the whole thesis that I'm playing. Chasing developed assets that pay a yield, that actually reward the investor. So in the gold sector, I bet big with Ross on Equinox Gold. I think that is a no-brainer at current prices. And I think if you want another one on gold that no one's talking about, I think Liberty Gold is a no-brainer. I'm one of the largest shareholders, so I'm talking my book, but I don't give a crap. If it wasn't good, I wouldn't buy it. I think they've made a world-class discovery, and the guys on that are world-class with Moira and Cal Everett. Moira Smith is, I think, one of the best geos that... Here's an interesting thing. I actually think that our industry is so upside down. If she was a man, she would get the recognition, and I think everyone would recognize that. But because she's a woman, for whatever reason, I think that's how stupid the resource industry is. I think she's one of the best geologists, period, I've ever met in my life. And Liberty's really lucky to have her, and I think it's a world-class discovery that nobody's talking about. And then again, I talked about, I think Uranium Royalty Corp is something that I've bet big. Your previous get, Rick Rule, him and I are I'm the largest investor, the chairman's the second largest, and then Rick's the third. I think that's the way to play it. So what you have to have 3-year time frames on both from today.
Gold or Bitcoin?
It's almost like saying gold versus silver. Why not have a little bit of both? Have all of the above. The point of having money is to make money. And I think that discrediting Bitcoin, I'm by no means any Bitcoin expert. I put my money with Mark Hart. I'm a pretty significant shareholder in his fund. He's a good buddy of mine, and Worth Ray that run that. And I just don't have the time to understand it, but I think he's really smart, and he's going to make me a lot of money in it. So why not have U.S. dollars? My portfolio, if I was to have my all-star team, go U.S. dollars, gold, some silver, some Bitcoin. Why not?